Welcome to another episode here. Today we have an exciting flex investment opportunity that I want to just share a little bit about what we're working on and how we're finding value in what's relatively a challenging market right now. If you've followed any of our previous updates, you know we've been pretty bullish on the flex space now for almost 3 years. We kind of rotated most of our stuff out of apartments and we've been focused on the flex space. For the most part, this space has been great for us in that we have seen strong revenue growth and we've seen a lot of leasing momentum. Over the past 3 years, we've purchased about 375,000 square feet of these types of assets. And every quarter for the past 8 quarters, we have seen positive occupancy growth and continue to lease. Most of what we buy here at Greenleaf is value add, so we're really buying stuff that has either vacancies or turnovers or we want to find stuff that there's issues to work through. So that's why we're able to have occupancy gains, is because we are continually adding deals that have the opportunity to lease and realize value. When we think about flex, the building that we're looking at here, it's 25,000 square feet. It's located right here in Atlanta. It has 2 long-term tenants, and they are paying fairly below market rents. That's a lot of what we're looking for. The other part we're looking for in flex is we want to see a building that's of smaller size. Really, they don't make a whole lot more that are in these footprints. So if we think 15 to 50,000 square feet, they're not making a lot of those type buildings. They're typically building, 200, 300, 400,000 square foot warehouses right now. Those are really hard to divide into 5,000 square foot increments, and they're almost impossible to build when there's not that much land available. We want to find stuff that's in suburban locations, but infill. So not urban infill, but suburban and fairly built out. Mostly all of our assets that we're looking to buy have easy access to highways and other major thoroughfares. So it's easy to bring in a truck. It's easy to get to where you're going. It's easy to get onto the highways from these locations. And typically, you're not too far away from everything. Within the flex space, we want to see multiple entrances on a building, and we want to see multiple roll-up doors or dock highs. Now, the difference there, the roll-up door is kind of like your garage door at home. It comes right to the ground. You can back trucks up to it, but you got to get out of the truck onto the ground. The dock highs, you can back really a semi in or a box truck, and then the bed of that is level with the warehouse floor. So on one side, you have kind of the truck entrances. On the other side, you've got the regular entrance door that you would see to an office. And inside, these things are pretty flexible, hence the name flex. I mean, you have a mix of office and warehouse ratios that are all over the place. With the majority of our leasing that we have done over the past really 2-3 years, we have seen everything from law firms to medical space to motorsports companies that are able to utilize this space. Current tenants that we're looking at are food prep related and dog care related. They have offices. They also have production facilities, all in one location. That's a lot of the reason we like it. We're always seeking value opportunities. And for the most part, these type of assets provide that for a tenant as well, because market rents right now in the areas that we're in, specifically this building here in Atlanta, are around $14 a square foot. Now, overall, that's pretty darn cheap. That's a good price point to be at for a space that you can put anything you want to in. You don't have elevators you're going up to. You don't have challenges with parking garages. You don't have any of that stuff. $14 a square foot. You have a wide open spot that you can put as many offices in as you want or leave as much warehouse space as you want. So it's very usable for an array of different tenant types. Now, our investment opportunity here is we're looking at this building at 25,000 square feet. We're purchasing it for around $90 a square foot. Overall, it's not that expensive from an acquisition standpoint. The value creation lies in that the current tenants have rents between $6 and $9 a square foot, and their leases expire at the end of 2023 and the first quarter of 2024. So by the time we close this investment and we purchase this, we'll have only about 9 months, maybe a year left before those leases expire. Now we're coming into this asset and we're saying we may have some tenants that are moving out. They may renew, uncertain, but we know that our target is $14 in market rent. We're building our pro forma. We want to hit our cash on cash numbers. We want to get above 10% on cash. And to do that, we only need to hit around $12 a square foot in rent. So we're looking at that as kind of our minimum. We know we can get to market, so we feel like we're in a good position. The other part we do is we're bringing a bunch of TI dollars to the table, and we're prepared to say, like, we need to come in and make some improvements, not because the asset necessarily needs it, but if we're going to help a tenant move into this space, we want to make it easy for them to come in and like the asset. We want them to feel good about the location they're in, sign a 5-year, maybe 7-year lease for the space. And with that, we're going to provide TI dollars to make that happen. We also typically have leasing commissions associated with it. For the most part, if a tenant is over 2,500 square feet, pretty much all of those tenants are bringing a leasing broker with them that's helping them identify and find what space that they're going to go into. And for that, pay a leasing commission that's typically 4% of the total lease. So we have to have those dollars set aside when we're going into a deal, so we are well capitalized to perform to those leasing requirements. From a physical standpoint on the outside of this building, there's not a whole ton that has to be done. We do plan to clean up the parking lot. We do plan to clean up the facade of the building, but these are not major expenditures. Everything is in good condition, but some fresh paint lines and nice numbers on the building never hurt. They certainly help make it look nicer. From a distribution standpoint, when we're acquiring assets like this, the leases that are in place, I mean, they are in place and they are there. So during the first couple months, as we have these in-place tenants, we're going to distribute whatever net income comes in on the deal. We do not expect that current net income to meet our preferred return goals, but we do expect once we're up to market or even 80% of market, we'll be over our preferred returns. We'll be hitting over 10% cash on cash, and that's really where we are able to create the value going forwards. That coupled with a 5 to 7 year lease as kind of our target, that really puts us in a position for long-term cash flow. Overall timeline, we think that will take us, if we're able to close here, really around the first quarter. It'll take us until the first quarter of 2024, so about 12 months for the whole current lease cycle to either renew or find new tenants to take that space. And then we're really looking at another quarter after that where we start making those increased distributions. Overall, this is what we're typically seeing in a flex deal. This is ideal for our investment scenario. We like that expiring within 12 months. We like that the building is in good condition. We like that it's suburban infill. We like it's below market rent, and we can lease it at market rent. Those are all exactly what we're looking for in an investment opportunity. For our limited partners, we have a full presentation that's going out with all of the details on how the money flows in this and what the 5-year projections and the P&Ls look like. Please let us know if you have any questions. We are excited about finding this opportunity kind of in a tough market. And even when, on this deal, we're looking at debt that's around 6%, 6.5%, and the deal still works very well from a return profile going forward. So thanks for watching. Please let us know if you have any questions. For more tips on operating and investing in real estate, please check us out at greenleafmanagement.com or find us on YouTube and Spotify.